following is a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the show. I'm Victor McClure. I'm your host and my co-host, Guy Allard. How you doing, Guy?
And he is also the birthday boy this week. Victor just had a birthday Thursday.
33 years
71?
old. Exciting,
what is it, 71? You got to take your RMDs now, don't you?
All I remember is a few years ago when I turned 50 and got that AARP package.
Oh, yeah.
I was like, oh, this can't be true.
A little story for our listeners. I'm 57. Victor's 53.
53, yeah.
So I'm letting him know that, when I used to have a Cadillac, at 50, I got the senior citizen discount, and at 55, I now get the senior citizen discount at lunch, and Victor says, oh, no, it's not worth the 10% for the embarrassment. I'm not going to ask for it.
That's right. Now, if it's online and I can check a box,
all right,
I'll do that one.
All right, there you go.
I'm not asking anybody, because I'm still pretending that I'm like 35.
There you go.
It
well preserved.
I know. We just reshot some of our videos up in Topeka. And every time I see a picture as I get older, I'm like, is that me really? Have I gotten that old? It's like, oh.
As you can imagine, we've, for the website, the name's changed and we're getting everything updated for that. And you always have a tendency to go with the older photos. Oh, I like that one better. Oh, yeah, it was 5 years ago. Of course you do.
Look, I have my cheekbones in,
yeah.
Oh, I had one that was like 15 years old, and I'm like, well, okay, I better not.
Can I get away with that? They come in. Where's the guy I'm supposed to meet? You don't look anything like your picture.
That's a reminder. Our corporate headquarters is moving to the Star.
Yay!
Dallas Cowboy headquarters.
That sounded like the cheerleaders in the background.
It's funny. When I was a little kid growing up in Preston Hollow, we had, I'd always draw pictures of the Dallas Cowboy players. And, my whole family's from East Texas and, they dyed, Dallas Cowboy stuff, everything. You go to grandma's house every Sunday and watch Dallas Cowboy games. Now, back then, it was on about a 20-inch screen that had about an 80-inch giant cabinet around it, right?
Oh, yeah.
It had rabbit ears, and every time somebody walked in front of the thing, the picture went terrible. You start yelling at them.
Yeah.
I told you not to stand up. Look what the TV did, right? Now this new age we're in. But, yeah, our new headquarters, it's $1.5 billion state-of-the-art facility, the nicest one in Texas, they tell me. And so we'd love to have you visit. We're moving the week of the 14th, I believe.
Barring any unforeseen occurrences. Right. And, we've had tickets to the Cowboys game in a box, and, usually some point during the game, a cheerleader will come up, and you get to pose and take pictures, and, of course, the wives get upset. That never works out real well. But for you single gentlemen who are working with us and getting ready to retire, Victor, are we going to have the Cowboy cheerleaders escort the prospects up to the office when they show up? Or?
Oh, I'm sure that can be arranged. No, not really.
No. Damn it.
Okay, that won't happen. But it is, like I said, you see the Super Bowl, even if you're not a Cowboy fan, which we're still in America, so I don't know how that would happen.
That's right.
But just the nostalgia of it. I'm not a Steeler fan, but I like to see the trophies and things and how they're operating.
Go to Canton and see the.
That's right.
Absolutely.
You just got to be careful, though. You can't just walk in and go grab the Super Bowl trophy because a SWAT team will descend upon you.
Yeah, the nets get cast on you.
I remember I just started wandering aimlessly before we were a tenant, and I'm telling you, like 3 or 4 of them came out with little earpieces on suits. I was like, oh.
Mirror sunglasses. That's right.
They're building the restaurants and the retail as part of this whole giant program. Remember, they got a hotel out there, right? The tallest building in Frisco. All this is part of this development. And so there's going to be, you can shop all day. You can go to a lot of different restaurants. So it's going to be a real neat place. That, Frisco, that's that, $5 billion mile? Something like that.
Now, if we're helping you put the pieces together and organize it so that you don't run out of money in retirement, which is what we are the very best at, we would advise you not to go shopping. Just come up and visit us.
You need to ask my wife to do the same too, right?
Well,
Please don't go shopping.
you know what happened when you and I were out of town for a couple days.
We get those email alerts when things went. It was going on fire when we were going.
I got a text message from my wife. Honey, we hit the jackpot at this estate sale. I'm like, oh no, that's expensive.
Oh, I couldn't pass up this deal. It'd be crazy not to do it.
It'd be crazy not to do it. That's right.
Well, today we're going to talk about. This is the comment I get from most people most of the time. Even though, we talk about stocks and dividend-paying stock, growth stocks, all those different kind of things. I get more calls on annuities than anything else. A lot of it is people know that we know a lot about annuities and have for 30 years. But we're going to kind of go over the history of annuities and what the good, the bad, and the ugly. Because sometimes an annuity can be a great tool, very useful tool. Other times it can be a real impediment to your retirement. You got to really know the difference.
And I got to tell you, this weekend we got to talk a little bit about our past and how we got started in the business for the videos. They ask you questions, and they were asking me how I got started and what was the progression, and it really made me think. Both of us are kind of similar, started in venture capital, managed commodities with the #1 ranked guy in the world for 5 years. 90s, it got into managed money and represented a fellow that was ranked #7 in the world, right? You can't go wrong with that until you get to 2000 and the market crashes. But anyway, and the progression. So again, venture capital, managed commodities, then it was managed money. You stay in the market long enough, you're going to get that 10 or 12%, and that's what you do. And then Victor and I, and actually Victor brought it to the table in 1995-ish, fixed annuities. And when we added fixed annuities, and the reason I mention this is for all those people out there that are stuck in the stock world. That's all they're going to do is stocks. They don't add the fixed annuities to the mixture. But when we added the fixed annuities to the mixture of a portfolio, again, sorting out and organizing your portfolio so that you don't run out of money. We try to shoot for age 100 most of the time on our deals. But when we added these fixed annuities to the portfolio, it took the burden off of the securities stuff, the stocks, the mutual funds, and allowed them to really prosper, and it handled your hard expenses and your cost. And it was really eye-opening, and I wish more people would get there and get the whole process, and I feel a lot of them are only giving you part of the puzzle by not using everything.
Yeah, like I said, we have guaranteed plans and non-guaranteed plans, and we'll show you both. We'll show you if you stay in this course, what if you add our managed program? What if you do nothing? You manage your own money. Just put inflation, cost of living adjustments, all those kind of things in there. And you'll find out, all right, here is what could happen to your particular situation.
Right.
Here is if you add this, what it does to your particular situation. If it's not positive, don't do it. And that's what we talk about all the time. Everything we do has to make a difference. It has to increase a stress test. It has to make, all right, if the market goes bad, you're better off. The only thing you can't do is you can't plan on making 20% a year during retirement. I see that all the time. Well, I'll make at least 12. For the rest of your life, you'll make 12, huh? Oh, yeah, I hear it all the time. Market's made 4.06 for the last 17 years, but you're going to make 12 forever. But I hear it all the time because people compartmentalize their money. They might be a great stock trader, but it might be 10% of their money. So they're making this 12% on there. But if they got a lot of it in cash, they're really making like 2. They just don't know it.
Think about it. If you could identify today with where you're going and the way you've got things organized that you're going to run out of money at 76 or 82 or whatever the age is, what a benefit that is. Because now you can adjust. You've heard Victor and I talk about it all the time. Our goal is to help you help prevent you from making irreversible mistakes. And if you can identify where the pitfalls and where the hurdles are, and this program does that today, you can adjust, whether it's adjust your expenses, whether it's shifting your funds to make sure you're
working a year later,
working a little bit longer. Anyway, you can adjust, and we're happy to help you with it.
The one thing that I want to share with people is a lot of people make absolute statements in this business. Let's say I'm a broker at some firm, and I say annuities are the devil's work. The worst thing you could ever do is an annuity. Well, first off, that's either an idiot or they're misinformed, because to deny the benefits is not a true statement. I know Ken Fisher's the greatest at it. It's the worst thing you should ever
I'd rather
do.
burn in hell.
I'd rather burn in hell.
I
yeah,
know, it's
right.
crazy.
All that is marketing. He's selling you something else.
Same thing's true if they say it about stocks, right?
That's right. Same thing if stocks are terrible. You should only do my annuity.
Should only do annuities.
That's right. All is ridiculous. There are benefits to every type of annuity. There are disadvantages to every type of annuity. And it depends on your particular situation. There's only one type of annuity that I cannot recommend no matter what I do. And it's not because it doesn't have benefits. And that's a variable annuity. Variable annuities have benefits.
And sometimes, if you can keep the fees down.
Yeah, it's just your fees can get up in the 3 to 5% range.
Yeah.
And so I acknowledge they have benefits. I just don't think those benefits are worth 3 to 5% a year. That's a big difference between somebody saying this is a terrible, I would never do that, it's ridiculous. Most good advisors will say, well, I prefer not to because of this.
And here's why.
That's right. I prefer not to do all stocks because of this. And those are valid arguments, but you got to look for yourself. And that's why our plan shows it. What does it look like in your portfolio? Remember, call us if you have any questions, 972-715-2424. We'll get you a free no obligation information kit, 972-715-2424, or you can go to ilovemyretirement.com. We got a break coming up, folks. Stay with us. We got the annuity show today. We're going to talk more. We'll return right after the break.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. All right, today we're going to go the history of annuities, good, the bad, and the ugly.
All the way back to Roman times?
That's right,
All
Roman
right.
times. That's what starts your immediate annuities.
There you go.
This is the kind that even the most hardcore anti-annuity advisors will still lean towards these.
Yep.
These are very simple. Basically, you give them a pot of money, they'll give you an income stream until you die. The benefit is, obviously, you can't run out of money.
Problem is, when you're gone, the money's gone.
That's right. And so, especially with baby boomers, we're both baby boomers, and it's very difficult to talk a baby boomer into signing something for life. No, this money's gone for life. So wait a minute. Me and my wife got hit by a bus after getting the first check. You keep the difference? Yes, they keep the difference.
That's about as hard as showing a 35-year-old life insurance when they can afford it and they're healthy.
Oh, yeah. So that's why they'll have the other ones. They have period certains. In other words, even if both of you die, somebody's going to get the remainder of 20 years certain. There's a lot of different choices there. But they're pretty, like I said, it's pretty simple. It's a pension. We're going to give you an income stream for a lump sum of money. Those are the simplest type, been around since the Roman times.
Same thing your company's been doing forever.
That's right. It used to be, I think, 20-something years, 30 years ago, it was 70% of companies offered pensions. Now it's like 9.
And declining.
I know. And they almost all those are frozen, you know.
And probably underfunded,
That's
just
right.
saying.
So, and somebody asked me this before, is a company pension safer than an insurance company? No. An insurance company is way safer because of the reserve requirements the states and the federal government have for them.
And we'll leave the companies nameless, but we've got several in our area that are buying out and allowing early retirement for their employees. And we've had just a number of folks call us not because it's not a good company, but they want to guarantee just in case the company isn't there. They want to be guaranteed assured they're going to get that payment.
Right. I don't want the company I work for guaranteeing a payment because if they go out of business, I'm screwed, right? I want some uninterested third party to be paying those payments. And that's what they do for a living, right?
Well, and inevitably, we've talked about it, municipalities, companies, all of that. Whenever they're managing large amounts of money in a can that they can kick down the proverbial road, it seems like they always get underfunded.
Now, what's the benefit to this type of annuity, an immediate annuity? Is it's going to pay more income if you retire. Let's say you retire at 60 and you want income today. It will pay more because you're getting rid of the principal. So if you can defer income, you can get our income in a lot of different types of annuities that you keep the balance.
We're going to talk about the increasing income later?
We will.
All right.
All right. So immediate annuity is the oldest type. It's been around forever. Very few people ever say it's a bad thing. Just some people want to turn part of their money into a pension. If you have an advisor that says annuities are terrible, never do it, they're not really advising. They're just trying to sell you something else. The next type is just a straight fixed annuity. That's the kind, they got several types. MYGA is the only one to look for here. multi-year guarantee annuity. Because what you'll find with fixed, it's like a CD. They're called CD type annuities. You'll find a big teaser rate. I'm going to give you 6% first year, and then I'm going to give you at least 2% the years after. Trust me, it'll never be above 2 as long as you live.
And a side note, earlier in the week, Wednesday, the Fed did not raise the rates. 3/4, they let it stay.
So a MIGA would be a multi-year guarantee annuity. This is just like a CD. If you got a 5-year 3.2%, you're getting 3.2% for 5 years. Now, the benefits over a CD, even though they're called CD-like or CD-type annuities, are all gains are tax-deferred. All gains are, the entire principal and the gains are judgment-proof, especially in the state of Texas. Nobody can sue you and touch this money ever. And that's pretty good for you doctors and lawyers out there. You're able to get, if you're looking for a CD money, why would you get a taxable 1% CD, maybe 1.5%, that's subject to creditors and everybody else, or 3% that's tax deferred and not subject to creditors or lawsuits or anything else.
And if you're wondering, I'll peel that curtain back a little bit, give you some insight. The folks that I get calling me all the time for these 5-year rates, where you're getting 3.2%-ish today, opposed to 1.5%, maybe 2% elsewhere, are the CPAs and the CFOs of the world. They know these. They know it's double the rate and guaranteed.
See, my point is, any broker that says you should never do an annuity is wrong. Anyone says you should never do stocks is wrong. Anybody says you should only do real estate is wrong. Think about it. I just told you I can get you 3% for 5 years, have it tax deferred and judgment proof. And how could a CD paying 1% or 1.5% taxable and it's not judgment proof not be a fair comparison? I'll give you an example. You got $250,000 insurance on any fixed annuity. All right, it's from the state. It's not from the FDIC. But it's similar. You've got a similar thing from the FDIC with CDs. But over the $250,000, there's 100% reserve with an insurance company. Your bank does not reserve crap over the $250,000,
no
right?
way, that's right.
They don't reserve anything up about 7% reserves anyway. And so it's much safer. It'd be more like a company, say a bond. We're going to pay you this bond, and we're going to put your money in escrow over here. And so if anything happens to us, this bond goes to you.
Doesn't happen that way, does it?
No. It basically, a bond is just a promise to pay. So if you have a 10-year bond paying 3.5%, with no reserves, just a promise to pay, why wouldn't you pick a 3.5% tax-deferred judgment proof? That's why straight fixed annuities or MIGAs, CD type, are very good as far as a fixed income alternative. They're not going to make 20% a year. That's not the purpose of them. This is your safe piece. You can't have all your money at risk when you're 80 years old unless you're okay with taking huge risk. Okay? So that's the two first types of annuities. We're going over the rest of them after the break. But there's an immediate annuity, been around for thousands of years. There's a fixed annuity, been around probably 100 years. It's just a CD type of annuity. It's just giving you an interest rate. Remember, if you have any questions about an annuity you've heard of, we can tell you pretty much in 5 seconds what type they are. Everybody thinks they have this type, but they really have this type. Our number, 972-715-2424, or go to ilovemyretirement.com. We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome. I think I need to change that bumper, a rejoiner.
We're experienced at something.
It just makes it sound really dang old. We do have over 30 years each experience.
Oh, yeah.
It's funny. Sometimes you'll say our combined office is 20 years. Well, one guy's got 19 and the rest of them have none, right?
Yeah, they talk about too soon old, too late smart. That's the advantage of experience.
We're talking about annuities today, the different types. First type you had was an immediate annuity. It's like a pension. You just turn your money into a pension. The good part is you can't run out of money. The bad part is if you die before your life expectancy, they're keeping the difference. Fixed annuities, just like CDs, they pay you an interest rate. They're called CD-type annuities when you do like a MIGA, which is a multi-year guarantee annuity. I prefer those better than the high first-year rate and the floating rate afterward, because the floating rate afterward will never pay you because they got to make up the commission they paid the guy or gal. They got to make up the loss from that first year since they gave you 6% the first year. And so it'll never get above the minimum rate after that. So don't choose those. Just choose a MIGA, multi-year guarantee annuity. if you're looking for a CD or bond alternative. Very good for CDs or bonds as an alternative or a dividend-producing stock alternative. Remember, the S&P has less than a 2% dividend, and you could get, say, 3.5
And
on these. And the dividend's not guaranteed. This is.
If you want to, some of these CD-type fixed annuities, 5-year, what have you, you can access 10% of your money, more, which is more than just the interest rate. Penalty-free withdrawals. There's some things you can do with those as well. Get a little bit more access.
And so, remember, even if you're 30 or 100, all of your money's not going into a risky stock program, right? You're going to have part of it safe. So that's what we're talking about. The fixed annuity is an alternative to a CD or bond. Right now, they're paying more, and they don't go down if interest rates go up like bonds do. It's guaranteed. You'll know what the thing is. And on top of that, all annuities are tax deferred and judgment proof. Judgment proof is a real good thing if you live in any kind of litigious world, in a litigious career.
Doctors.
All right. The next type of annuity came out in the 50s. This is a variable annuity. Variable annuities, you've heard me rail on them for, 20 years now. Not that they don't have benefits, because there are some benefits. Let's say I'm a doctor and I'm worried about people getting sued, and I want the stock market, and I want it tax deferred and judgment proof. I know I got to pay a little bit more fees for it to get that, but it's worth it to me particularly, right? The only reason I say that I still wouldn't do it is because there's other alternatives that can give you similar benefits without the cost.
But, if you're a teacher and you're still working, they have some of the lowest cost variable annuities available to them, and it's a very good craft.
The retail variable annuities now, the fee structure, when you add all the rider cost, the mortality expense charges, all of those things, and the funds cost, because you're buying mutual funds in there, right? They're totaling 4 to 5% a year.
And you wonder how do they sell something with 4 or 5% fees? The market's only averaged or compounded 4% the last 17 years. And the way they do it, and they explain it, they have one of the riders that you've just purchased for 1 or 1.5% a year guarantees you a 5 or 6% rate of return, right? So you're safe. But again, it's for income. And during the time that you take it during income, unlike the fixed alternative, there's no growth while you're drawing it. It's stagnant.
Remember, if you pay me 5% a year, I'm one happy guy.
Period.
The person buying it is never going to be happy because you can never fade that kind of fee. Period. So stay away from that. Now, does that mean all variable annuities are bad? No. There's some from TIAA CREF,
right,
some from Vanguard. If you're just looking for the tax-deferred, judgment-proof part, they'll fit that bill. Now, some of them aren't guaranteed. You got to be careful because a lot of the retail ones come with a guarantee of principal at least at death. They do not. The lowest cost ones. You're just trying to get, I want stock market returns.
Protection.
I don't want anybody to sue me and be able to touch this money. So there's not all bad. If I had to choose, those are the ones I'd choose.
And I should disclaim that nursing home, those sort of things seem to have a way to get to those funds, and they count against you in the 5-year look back. So you can't hide from those.
Can't be sued from them.
That's
they
right.
They can find it for Medicaid purposes.
But you can't hide your money from a nursing home and those sort of things.
Oh, so we hear that every day, right?
Can we do that? No.
So variable annuities have their place sometimes. There are just other products that have been invented since then that aren't. And so here's the chronology of it, right? You had immediate annuities, been around since the Roman times. Then you had fixed annuities. They've been around like 100 years or so. Now you got variable annuities, been around about 60, 70 years since the 50s. Now the last type, index annuities. Index annuities came out in 1994, 95, and they have kind of taken over the annuity world. We're going to tell you why after the break.
They've taken over the investment world, haven't they, kind of?
Don't hesitate to call me at 972-715-2424. We can get you out some information, and you can study up on these things for yourself. 972-715-2424, or you can go to ilovemyretirement.com. Stay with us, folks. We got a break coming up. After the break, we're going to talk about index annuities, the good, the bad, and the ugly. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080, KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. Remember, I was getting ready this morning. I had Alexa talking to me.
Oh, did you? I didn't think
I had her play
who Alexa was.
Jefferson Starship, Jane.
All right.
You remember that
I
song?
do. I do.
My wife, who is not in my generation, but she says, you like that hairband crap. I'm like, hey, this 70s, 80s stuff is fantastic.
That's right.
I was jamming in there. I usually listen to mostly country now, like Texas country, but, well, that old rock still gets me, though.
Mine's kind of 60s, 70s.
Right.
Even the country stuff, like the old George Strait and stuff,
Right.
I prefer to the new stuff.
All right, we've gone over the chronology of the history of annuities. First, you had the immediate annuities. Romans started this, actually. Then you had the fixed annuity, probably 100 years or so ago. That's just a CD type of annuity. Pays you an interest rate.
We copied a lot from the Romans. The
Oh.
Senate, and do I need to go on?
First,
Just a lot
plumbing
of stuff.
systems, all kinds of things. Right?
Absolutely.
And then you had variable annuities came out in the 50s, I believe. And variable annuities, when they first came out, the fees weren't crazy like they are now. But now they've got so many protections and things. Variable annuity sales have plummeted in the last, 10 years.
Sure they have.
The one that has gone up pretty much in those 10 years, index annuities.
And that's one that you'll find the true dyed-in-the-wool stock guys fighting tooth and nail, because all this money that's going to these new fixed index annuities, where do you think it's coming from?
It's not a variable annuity. You're not actually in stocks, okay? They buy options on stocks. They put almost all your money in bonds, just like all annuity insurance companies do. All the money you give an insurance company, by the way, 90-something% of it is in bonds. That's how they reserve, and that's how they take care of their guarantees.
They're not taking any risk.
No. They take some, but it's pretty small, right? So index annuities will give you a portion of a stock market index. They're either capped or uncapped. Like some of them say, all right, I want you to get in the S&P. You'll give me the first 2%, and you get the rest. And what I'll do is I'll guarantee you'll never take a down year. If the market ever goes down, you just get zero that year. That's not bad. We've got them that the worst they've ever done is 4.2% of a rolling 10-year period. When we know the market's only made 4% for the last 17 years, that's not bad, and you could never watch your money go down at all, ever. Locks in your gains as you go. So if I've got 500,000, now it's $1 million, I can't lose $1 million. Goes to $1.2 million, I can't lose $1.2 million. It locks in your gains either every anniversary, or sometimes you can do a higher return strategy for every 2 years or every 3 years.
Multiple year period, that's right.
These are a little more complicated than the other type of annuities, no question about it. But they have more benefits, in my opinion, than the other types of annuities. And the highest cost in the business is about 1% a year. So those people that tell you all annuities have high fees are not telling you the truth. The truth is these only have 1%. Fixed annuities have none. Immediate annuities have none.
And mutual funds and money managers charge 1% to 2% on a growing asset every single year. Right. You're going to pay it.
So there's 4 kinds of annuities. Sometimes you can put a deferred annuity in there. It's kind of a delayed immediate annuity. All 4 have no fees. You can add a rider to get 1% fee on a couple of them. Why? How is that too high of a fee? It's not. What they do is if I don't like annuities, I'm going to punch them all like they're the same. In other words, variable annuities at 4 or 5% fee, that's the same as all of them. So you should never pay those ridiculous annuity fees. They're just referring to one type. Don't do that type. If you can find something with no fees that accomplishes what you want, you might want to look at it or consider it. And that's what they do. So up years of stock market indexes, no down years. You can do them with a cap, in other words, a maximum on what you can earn every year, or without one. And so think about this. Let's say I can make 0 to 15% every year. Or let's say 0 to 10, make it even better. I mean, worse. 0 to 10% on index annuities is the worst you can do. You're going to make something or nothing, right? Well, stock market, you can make, 20, 30 in a year? You can lose 20, 30 in a year. Maybe 40 or 50 either side. So tell me why that's not decent. There are some people that would prefer a 0 to 10 all day long than a negative 30 to a positive 30. I'm one of those people. So on its own, to me, it's better than a bond. Right now, 10-year bonds are paying, say, 3%. And if interest rates go up, they go down. Defaults go down as interest rates go up. We haven't experienced that in years because interest rates have gone down for so long. But when they start going up, you got exponential defaults on bonds. CDs, they're not paying enough. And so you could do an index annuity illustration. The worst it's ever done over a rolling 10-year period might be 4 or 5%. Well, that's decent. And so I'm okay with that. Remember, all annuities are tax deferred. All of them are judgment proof. Nobody can sue you, touch this money ever. And all of them in the index annuities lock in your gains as you go.
And if I can, just to add a little clarity, because one of the questions I get all the time from first visit clients, if you will, potential clients is, how's the insurance company making money? Are they taking risk? How does that work? And again, Victor touched on it earlier. Your money, basically all of it's in bonds. So what do those bonds do? They throw off interest every year and refer to that as a renewable asset because they can take that interest 1 year off of your money based on how you select to have your interest allocated. They buy a call option on the stock market if you want to go in the stock market. If you want to go in the fixed account and get a fixed rate, you can. If they go in the stock market and the stock market loses 30%, that option expires worthless, right? And what does your bond do again? It throws off more interest next year, so we can do it again.
Options.
Yeah, you can buy an option on the stock market. You can go in a fixed account. They're not risking anything, and that's why these things can be guaranteed.
I mean, the one thing is, if you could do this on your own, you could put most of your money in bonds and buy options. The only problem is option prices can go from $500 to $25,000 in 1 day.
And what controls the price? Volatility and term. And these are long-term in a volatile market.
And if you make a mistake, it might end your retirement. If they make one, they contractually are guaranteed to eat it. So that's why they're buying options. They're giving you, so the end result is you're getting stock market linked returns without having to risk any of your money in the stock market. To me, it's just a better way with a portion of your money. Remember, I like the stock market. I think it's the best for long-term inflation, to beat inflation, for diversification, for liquidity. I love it. I just love it after the bills are paid. With a fixed annuity, you could do it with a third the dollars that it would take to do it with anything else.
And the younger you are and the more money you have, the stock market's a better place.
That's right. I got a break coming up, folks. Stay with us. Remember, if you have any questions, 972-715-2424, or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Today we've been going over the history of annuities, the good, the bad, and the ugly. Remember, I haven't gone over the negatives of index annuities. Well, the negatives of index annuities is if the market just ran like a scalded dog for 10 years and you had one that was capped or something like that, well, it didn't save you anything because it never went down in those years. A fixed index annuity is really good if you got a volatile market. If you're going to have up years and you're going to have down years, because we're only capturing the up years. So it's very good for stuff like that. So just to recap, immediate annuities, Romans started that. That's just a pension. You give a little bit of money to the government at that time. They send you for you and your spouse for life, a monthly stipend or whatever.
Kind of like Social Security, right?
Yeah, except there's no money left in there.
No,
Right?
I understand.
Then you have fixed annuities, just like CDs. They just pay you an interest rate. Unlike CDs, all annuities are tax-deferred, judgment-proof, and avoid probate if anything happens to you. A lot of benefits on top of that. If you got a same rate, if I got a CD for 3 and a fixed annuity for 3, I'm taking the fixed annuity because of the other benefits, the tax-deferred, the judgment-proof, and all that. But the truth is right now, CD's paying 1.5, and the fixed annuity's paying 3, and with the benefits. Okay. Then you had variable annuities, came out in the 50s. They're in the stock market. They actually own the stock market. They own mutual funds. They call them sub-accounts, but they're just mutual funds. The problem there is their fees have gotten ridiculous over the last 20 years. They're in the 4 to 5% range. What happened is people started squawking about these fees. They raised them and raised them and raised them in the variable annuity field. So they started new share classes of the same mutual fund. You can go American Fund, Euro Pacific Growth, which is the largest international fund in the world, and you can have twice the fees in your American fund. It's the same manager, same stocks.
You're talking about A, B, and C shares?
A, B, C, D, F. They got a whole bunch of them.
Right.
They went just for variable annuities to charge you more fees because people don't look that far. They might look at the charges up front from the insurance company. They forget the charges on the mutual funds.
I don't know what happened to it, Victor, but I remember 5 years ago, the regulatory bodies were talking about putting a little red label on the front of the prospectus that itemized the fees like ingredients on food.
It's in the first 10 pages. People don't read it.
Yeah, but they're on like 5 different pages. It's not in one area.
You can read it pretty quick, but it'll show you, let's say you're considering putting $500,000 in a variable annuity. It'll show your fees could be $5,500 over the next 10 years or $6,000. And you're like, well, that's not too bad on 500. Read the small print. It's on 10,000. You put in 10,000, we could charge you 6,000 in fees over 10 years. That's ridiculous.
50%.
Oh, it's more. Some of them are 8,000 out of 10. So I cannot recommend a variable annuity in its current form, except for TIAA CREF or Vanguard. Those are low cost. Okay. Then you've got index annuities, came out in 94, 95. They are the most popular annuities of the choice. Don't get me wrong. Variable annuities, I think, are still outselling them because their distribution network is so large. All the big firms you've ever heard of still do a lot of variable annuities. But the trend has gone way away. They've dropped precipitously.
Think about Walmart.
And index annuities have come huge. Index annuities are you get part of an index. You can either get one with caps or no caps. You lock in your gains as you go. So it's an alternative to fixed income. Now, just to throw a monkey wrench in the whole thing, we've got those annuities. About 10, 12 years ago, they started adding riders that had never heard of at the time. They started with variable annuities. Remember, you're in a variable annuity, money goes up or down. With a retail one, your principal's guaranteed if you die. If you live, you want to cash it out and it's lost half its money, you get half your money. Well, they said, let's not do that. Let's give them a guaranteed 5 or 6% a year and then be able to take an income stream off this phantom dollar or this other dollar, income stream
Forced
dollar.
annuitization.
The cash value is the cash value. It's what the stock market minus 4 or 5% in fees. But then people started buying them like crazy because I do want the stock market without the risk. The problem is, like I said, the cash values never go up because they're paying too much fees.
Got exhausted.
That's right. And so about 7 years ago, index annuities added the same rider. It's a living benefit rider. It says, remember, we're going to give you up years of indexes, no down years. It's all tax-deferred, judgment-proof, and avoid probate. On top of that, we're going to guarantee a 6-7% a year for an income stream in the future. The payouts were higher than the variable annuities, and the fees were about 20%. The highest fees I know in this side, on the index side, about 1%, maybe 1.5%.
And there's some that have increasing income with no fees.
That's right. You can get no fees on that space. And so if you're looking to create a pension, remember, you have those choices. Annuities are the only thing on the planet that will guarantee for the rest of your life that they'll pay you. But there's too many bad things about an immediate annuity where, if you both got hit by a bus, the money's gone. With a fixed annuity, they're fine if you can live on the 3.5% or 3%. A lot of people, you'd use an index annuity because I give you an example. I got $1 million. I'm going to retire in 5 years, and it's going to pay me $80,000 a year on that $1 million. Now, think about any other choice you've got. CDs would pay you about $10,000 a year on that $1 million. Bonds will pay you about $30,000 a year on that $1 million. I just guaranteed you 80. If you do 10 years, I'll guarantee you 100.
And you want an expert to guide you to the right annuity because, like bonds, you can get B-rated and C-rated companies guaranteeing your investment.
There's 144 choices in just index annuity income riders. There are thousands of them in variable annuities. You need a real expert in this because someone will sell you something that just pays the most commission. It's not the best for you. We've been doing this a long time. And we'll tell you the good, the bad, and the ugly. You make the decision. We'll put it in your portfolio in our software, so you don't have to test drive it yet, and it shows you what it does to your portfolio. That is what really you want to do, is see if it really will help you or you and your family. Well, that's our show, folks. I want to thank you for listening. Don't hesitate to call our hotline, 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. We hope you see us at the Star. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the